I'm starting to feel like right now could be one of the most dangerous times in history to select a mortgage. If you make the wrong decision and choose the wrong one, it could have pretty severe consequences. And I feel like that's a crazy thing to say, especially considering the consequences of choosing the wrong mortgage a couple of years ago. But it seems Canadians have not learned that choosing fixed versus variable is less about trying to time the market than it is about risk tolerance. And with bond market yields hitting a 6-month low, certain economists predicting that the Bank of Canada is going to have to cut interest rates by up to 3%, which may not actually be the case, and variable rates once again becoming one of the most popular mortgages on the market, even though they are priced so much higher than their fixed rate counterparts. I feel like people are once again taking a day trading mentality when it comes to the biggest financial decision of their life. And I'm not saying that you shouldn't be getting a mortgage, but what I am saying is that you need to fully understand the differences between fixed and variable rates before you jump off a cliff into one or the other. And I also need to clarify that none of what I'm about to tell you is individualized personal advice for you. You need to seek out the advice of a professional, and when making your decision between fixed and variable rates, don't just watch a 13-minute YouTube video and think that you have all the information that you need, because you probably don't. But I want to give you at least a little bit of direction on what's going on with the interest rate market, show you exactly what interest rates are today, and help you better decide between that fixed, variable, and short-term mortgage equation. So without further ado, let's take a look at what's going on in the mortgage market. Okay, so let's start first by taking a look at the 5-year Canada government bond yield. This is the yield that dictates fixed rate mortgage prices. And this is now 1% lower than it was at its highest rate, which was October 5th, if I'm not mistaken. Sorry, it's October 3rd high of 4.41%. So we're now 1% lower than we were at the highest rate, which was about 60 days ago. And the reason for that is the expectations with respect to the Bank of Canada and the Federal Reserve in the US and how much they're going to reduce rates in the future. Obviously, the lower interest rates go, the greater the expected rate cuts. And this is leading to a lot of confusion around interest rates and mortgage rates, and it may be causing some people to choose the wrong mortgages. But before I get into that, I want to show you what economists are saying right now with respect to Wednesday, tomorrow's Bank of Canada decision. So it is widely expected that the Bank of Canada tomorrow is not going to increase interest rates. Most economists are suggesting that there's no justification for a rate raise at this point. And nobody yet is quite suggesting that interest rates will be cut tomorrow. But what most economists are suggesting is that rates are going to stay put, and we're going to get some insights into what the Bank of Canada is thinking with the situation going forward. Now, in addition to what's going on with the Bank of Canada tomorrow, many are suggesting that the Fed in the US is also done hiking interest rates, but some bankers and economists in the US are saying not to expect interest rates to come down anytime soon, and that with inflation still being relatively sticky, we are probably going to have high rates for longer. And this is similar to what the Deputy Governor of the Bank of Canada has suggested, which don't expect interest rates to come down soon, and definitely don't make your borrowing decisions based on the expectation that interest rates are going to come down substantially, because they may not do that. And if inflation proves to be sticky, they could in fact stay higher for longer. And that is showing with the bond market, where traders are now predicting that interest rates may not fall as much as predicted. And while at the same time you may see bond market yields indicate that interest rates are going to come down a ton, that may not necessarily be the case, which is why the Bank of Canada's Deputy Governor is saying that ultra-low rates may not return. But I can see where that gets confusing when you have people like David Rosenberg saying that they're going to have to slash interest rates by 3 percentage points. Now, here's the thing you need to understand. There's different types of economists. They have different motivations. Rosenberg is somewhat famous for being somewhat correct when he predicted the financial meltdown in 2008. And his future predictions, just like every other economist, are probably not going to be accurate going forward into the future, because they are just that, predictions. They're forecasts. And typically, even though economists are often judged by the one thing or the two things they got right or wrong, they are more often wrong than they are right. But the problem with a prediction like Rosenberg saying that interest rates are going to have to go down 3% is that people may make their mortgage decisions off of this headline. And here's the thing you have to understand about a guy like David Rosenberg. Great economist, but the thing that he is world class at is getting media attention. And this kind of headline gets him media attention, whether he actually believes that interest rates are going to go down by 3% or not. And I don't know if he actually believes that, but I know he's really good at getting in the headlines. But if you make your mortgage decisions based on these types of headlines, or based on watching a 12-minute video like this one, guess what? You could be making a really bad decision because you haven't consulted a professional. So I hope you're seeing a theme here. Always consult a professional when you're getting a mortgage so that they can assess your risk tolerance. And also so that they can make sure you don't have any blind spots, like choosing a variable rate mortgage with a fixed payment when you didn't understand that there was a difference between a variable rate and an adjustable rate. But here's the reality of the current mortgage situation. If you're choosing a mortgage in the near future, you need to understand that this is all about risk tolerance. It's about choosing the right mortgage and knowing what your risks are on either side. Because if you choose a variable rate mortgage right now that is priced significantly higher than a fixed rate mortgage, with the expectation that interest rates are going to come down 1% or 2% or 3%, you need to understand that that may not actually happen. And in a lot of cases, a bird in hand is better than two in the bush. So if you can get a significantly lower interest rate on a 5-year fixed or a 3-year fixed or a 4-year fixed, and I'll tell you what all those rates are in a second, you may be better off in the long run if interest rates don't come down the way that they're expected to. And keep in mind that Tiff Macklem in 2020, 2021 was saying interest rates are going to remain low for a very long time. And look at where we're at now. So predictions, forecasts often end up being wrong, which means you shouldn't be choosing your mortgage based on forecasts. The correct way to choose your mortgage is based on your own personal risk tolerance and the information you have in hand at the moment, which is today's current rates, which I'll show you in a second. Now, you can make the decision to choose your mortgage based on where you think interest rates are going to go. But if you do that, you have to understand that you are gambling. You are making a bet and you need to understand what the consequences are. Because even though the market is predicting that interest rates should go down, they could in fact possibly go up if inflation remains sticky and continues on for the next year or two. Now, as a quick side note, if you've been watching me for a long time, you may think this is me changing my tune with respect to choosing a fixed versus a variable rate mortgage. It is not. This is the exact same strategy as in 2020, 2021, 2022. You first choose your mortgage based on your risk tolerance. If it's going to keep you up at night, if your interest rates go up, or if you cannot afford for your interest rates to go up, you choose a fixed rate mortgage. If you can handle the risk, but fixed rate mortgages are substantially cheaper, you choose the lower rate at the time that you get the mortgage. This is all based on the work of Mosh Milewski. And in my mind, at least, it's as true today as it was back then. So understanding your risk tolerance is the name of the game. That's why I wrote the Mortgage Secrets book. That's why I created the Rate Secrets course. If you want to get those two things, I'm leaving the Rate Secrets retirement sale up so you can still get it for $27. It includes a copy of the book. So you'll have the tools that you need in order to make the decision. But again, I cannot emphasize enough that you need to have professional advice and you need to have somebody assessing your risk tolerance and helping you understand what the differences are between the different types of mortgages and that you're getting the right one. Now, with all that being said, let's jump into the current interest rates. These are the 5-year fixed full featured mortgages, the best mortgages you can get in Canada. They do not come from big banks. The reason for that is because they have better features and often better rates or similar rates, but just like anything else in life, you get what you pay for. So these are the mortgages that have the best overall packages. And the reason why they have the best overall packages and are better mortgages than the big banks is because they have to be better mortgages because they can't skate on their marketing budgets and their reputations in the same way that the big banks can. So we call these A-plus mortgages. They're better than the bank mortgages. They come from companies like First National, MCAP, CMLS, and other lenders that are very similar to those. And one thing to keep in mind, if you're going to get a 5-year fixed rate, these are the type of mortgages that you want to have because they have lower payout penalties, which means if interest rates do actually go down, you've got options in order to get a lower rate. If you have a big bank 5-year fixed mortgage, you probably aren't going to have those options going into the future if interest rates go down. So taking a look at what these rates are, insured mortgages have come down to 5.54%. Greater than 35% down, these are 5.54% as well. Once you get to 35% or more down payment, that creates a similar risk profile to a completely insured mortgage for the banks. At 30% down, you're looking at 5.64%. At 25% down, you're looking at 5.69%. And at 20% down, you're looking at 5.79%. Now, I've been reading some comments on the internet. People are wondering, well, why is it that when you put 20% down, you're paying higher interest rates than if you have an insured mortgage? If you're putting more down, it shows more financial responsibility. You should pay less. Well, the reason why is because a 20% down payment mortgage represents the highest risk for the lenders. And look no further than the Toronto real estate market right now, where prices are down almost 20%. And a lot of borrowers who put 20% down are now underwater on their mortgages. And if they didn't have insurance, the banks are exposed. So that's why rates are cheaper if you have insurance or you get to 35% down payment. It's because that's where the risk and the exposure is the least for the banks. Now, if you're getting a mortgage that is over $1 million, you want a 30-year amortization, or you're doing a refinance, you're looking at significantly higher rates again because these have greater exposure for the banks, 6.24%. Now, I've added in 3-year and 4-year mortgages this month. Just going to give you the 4-year rates so you understand where these are at. They're very similar to the 5-year fixed rates if you're greater than 35% down or insured. If you are looking at 30% down or 25% down or 20% down, they're a little bit higher. And obviously uninsurable, even higher than that. If you want to take a look at these, go ahead, pause the video. And then 3-year mortgages are even higher. Current best rate is 5.89%. Greater than 35% down payment is 5.89. And then when you start getting to 30% down payment, 25% down payment, 20% down payment, again, higher interest rates. Now, think about this. If you're looking at a short-term mortgage because you believe interest rates are going to go down, you could be making a mistake because if the rates don't go down, you've paid a premium for that short-term mortgage over a 5-year fixed, and you've got 2 years left where your rates are locked in. And 3 years is a long time. Anything could happen. We could find interest rates 3 years down the road considerably higher where they are now. They could also be considerably lower, but we don't know that. So if you get a cheaper rate, lock in for longer, make sure it has a low penalty so you can switch to another lender for a lower interest rate at some point. That may be a better option than paying more with the expectation that interest rates are going to go down, only to have them not go down. Oh, and full disclosure on all of this stuff, mortgage brokers, mortgage specialists do get paid more when you take a longer term mortgage. Whether it's variable or fixed typically doesn't matter, but if you take a 5-year over a 3-year, yes, they will get paid more. But at the end of the day, it's not about whether or not you are choosing a 3-year or 5-year mortgage and their compensation. It's about which one makes the most sense for you and your risk tolerance. And for most people, that means choosing a lower rate with a longer term guarantee. Now, moving into 5-year variable rate mortgages, full feature. These are pretty much the same as they were last month. I'm not going to go into great detail on these, but if you want to take a look at them, just pause the video. And if you're looking at 5-year fixed discount mortgages, now again, just like everything else, you get what you pay for. These are mortgages that come with restrictions, which means you may not be able to refinance and get a lower interest rate. You may not even be able to leave the lender until such time as the mortgage comes up for renewal, which I'm a big believer. If I borrow money from you and I want to pay you back and go somewhere else, I should be able to do that. But discount mortgages often come with the inability to do it, and it causes a lot of complications, especially in environments where interest rates could go down. And then variable discount mortgages, you can take a look here. Again, considerable problems with these. But when it comes to choosing these, clients of Mortgage 360, we will take them through the differences between normal mortgages, full featured mortgages, discount mortgages, help them understand the differences between all the different types of mortgages, and make sure they have the information they need in order to make an informed decision and choose the right mortgage for them. And I'm going to tell you right now, if your mortgage broker is not assessing your risk and going through all of these things with you, you should be looking for a second opinion. And if you're going directly to your bank for a mortgage, well, guess what? It's almost 2024. Everybody in Canada should now know that your bank does not necessarily have your best interest at heart. They're sales organizations first and foremost. It's about profits for the shareholder. And the only way to make sure that you get the best advice is to go to an independent agent who has an obligation to do what's best for you, and then make sure that they're actually doing what's best for you. So those are the interest rates for December of 2023. I fully expect that these interest rates are going to come down even further. So make sure you watch for more rate updates. And if you want to see more information on what's going on in the Canadian mortgage market, especially with respect to lenders deselecting clients, make sure you check out this video right here.